Welcome to the daily update, where I'll go over the action in the market for Friday, December 29th, and we'll see how things look for Tuesday, January 2nd. We had the last trading day of the year. It ended up being a down day. It was a little more pronounced if you look at the chart, because the movement that we saw was a lot greater than what we've been seeing over the last few days. But we ended up not being down all that much. We've worked off a few of our overbought conditions, but for the most part, we're still in an overbought situation. There are some real vulnerabilities and negative divergences that we're seeing in the charts, and I'll try to point those out as I go through the different charts. We're still in that phase of the Santa Claus rally, where that's the last 5 trading days of 2023. It'll be the first 2 trading days of 2024. If they end up being up overall, then that tends to be pretty positive for the market looking forward. I also have the new stock market or stock traders almanac statistics to show you for Tuesday. So for right now, we're still positive, but the market is also vulnerable at the same time. I want to wish everybody a very happy 2024. I hope 2023 was very good to you. There are a lot of things that I plan on unveiling, new things, classes that I want to enroll. I have a whole program that I'm going to start to make available in 2024. There's some new videos that I'll be posting. So I hope that in a small way, I can help you in your endeavors in the stock market to make 2024 to be a very good year for you. Let's go back and talk about what happened. Right at the open, we had a pretty flat open. It looked like, okay, we're going to have another yawner of a day. And prices chopped along the daily pivot at 47.86. Then as the day went on, we saw some selling coming in. Now, we were more negative on a seasonal basis. So to see a down day on the last trading day of the year is not really a surprise. We fell down below the unchanged level, which means that we went negative. We went below S1, which was not really all that hard to reach at 47.78. We went down below S2 at 47.74. We even got down to S3 at 47.61. And then we fell below that, and we found some support right around, just a little bit above the 47.50 level. But then we were able to rebound up off of that, and that's rather encouraging. We came back above S3 and S2. We closed just a little bit below S2. We were down 0.28%. We were down a lot more than that earlier in the session. So the market was able to pare a lot of its losses, but volume is still well below average because we're in holiday mode. We are positive with the technicals, but we're still extreme positive. We're looking not only extreme at our charts, but also on a sentiment basis. Folks are really positive on the market right now, and possibly a little too positive about where things are going. And when we get really extreme like that, that's when we start looking for contrarian indications that we might be due for a pullback. And then if a pullback does start to happen, is that going to turn into an actual reversal? Of course, we're paying attention to inflation and interest rates, and that's what's making the market environment more positive, because inflation has seemingly come under control, at least to this point, and we're possibly coming into 2024 where the Fed may end up lowering interest rates. But we also want to keep an eye on all the different geopolitical events. So some comments that we can make: we're getting to the end now of holiday mode. When we start on January 2nd, everybody should be coming back because the Christmas to New Year's break is pretty much over. But we'll still have a couple of days left of the Santa Claus rally. And then the January effect doesn't really have a set period of time. We're just wondering, even though the small caps were kind of weak on Friday, are they going to regain some strength next week? And small caps did underperform in Friday's session. And since October 27th, that's when we hit a low, the S&P has been able to climb 15.8%. That's just about the time when it looked like the market was falling apart. If you want to see what I was saying at that time, because we were quite in an oversold condition and we were still hanging on to some support, we were vulnerable at that point, but we were able to establish a bottom and then come up out of that. So we've climbed pretty well off of that since that time. But for the year, the S&P was up 24.2%. So that was a pretty good year, more than double of the average that the S&P has performed over the long term. On a short-term basis, though, we still have a lot of extreme positive indicators that are giving us an overbought condition, even though the list is a little bit shorter. We have our short-term ADX, and that's starting to roll over a little bit now. It's crossing below its moving average, and I'll show you that chart. The 20-period exponential moving average, the Williams percent R, the stochastics, and the PMO oscillator. Then intermediate term, our list is a little bit shorter, but it's still quite long with our intermediate term ADX. That measures the condition of our trend. The 50-period moving average study, our standard deviations chart. One new addition is the rate of change based on 50 periods. That's come back on this list, even with the down day. Our Rune indicators coming down a little bit, but still extreme. The PMO studies that we look at, the Sean trend meter, as well as the Chaikin money flow. The boom indicator based on 50 periods, and notice that the 20 period fell off of the short term. And we have the balance of power, the RSI based on 14 periods. The 9 period has come off the short-term list. We still have the bullish percent index for the S&P and the NASDAQ, and our new high and new low study for the S&P based on 10 periods. Long-term, we're still looking extreme with our 150 and 200-day moving averages. We're still dealing with the same basic scenario that the Fed might be done raising rates and possibly as soon as March even look at cutting rates. That's going to change a lot, especially when everybody comes back after the holidays. Volume really picks up. We have more economic reports. We're going to be getting the employment situation report in the upcoming Friday. That's going to be very telling. That'll adjust things as far as what the market thinks the Fed is going to do. And we are really seeing a shift. For most of the decades that I've been following the stock market, it's been the Fed following what the market does. And that's the way it should be. What we're seeing now is the Fed is really leading the market. And is that going to continue? Is that a new way of looking at things? That's when you have the market really paying attention to everything that the Fed says and everything that they do. It used to not be like that. And so we're wondering, if we get more into a favorable economic climate, is the market going to back off of listening to every word the Fed says and then let the Fed follow the market and see if that ends up changing in 2024? The dollar was up and interest rates were also up, and that put some pressure on stocks. The 10-year closed at 3.88%. We're still inverted with the 10 to the 2-year and the 10 to the 3-month. And sentiment is still extreme. We ticked down to 76 where we had been at 77, but we're above that 75 level. And that's when we're getting extreme positive and we start looking at sentiment from a contrarian viewpoint. Our trend is still positive, but now the ADX is weakening and they're both starting to drop below their moving average. Doesn't mean we're going to see a change in trend. It could just mean that the strong trend that we've been seeing for the last couple of months, specifically since the end of October, that could be finally weakening a little bit. Now, it could always turn strong again. It may weaken for a short period of time and then turn and get stronger. But just know for right now, it is starting to weaken a little bit. We're mixed with our bias because we had the down day, but it wasn't a real severe down day. And then when I take the last 2, 3, 4, 5 days together, our momentum continues to be positive. All right, some economic reports that came out. We just had the Chicago PMI. It came in much less than expected. They thought it was going to come in at 50. And when you're above 50, that's showing expansion, at least in the Chicago area. When you're below 50, that's showing contraction. And we came in at 46.9. Last time we were at 55.8. So that was a bit disappointing. Here's a chart showing the PMI where it was really up strong in the last reading that we had, and it's dropped off. It's right at 50 right now. Then looking at our intraday chart where we had a flat open and it looked like it was going to be a pretty boring day, but then we had some selling come in. And I tried to warn about this with the lower volume. You get a big player like a hedge fund or some institution, and they want to come in and do some selling, and it can really shift prices quickly because there's not a lot of counter volume to slow that down. And we quickly dropped down below S1, S2. We even dropped down below S3. We found support just above the 47.50 level. And then this is what was encouraging. We saw some buying once we established a support level. We came back above S3. We got up to S2 and then closed down a little bit below S2. Here's our intraday chart where we were pretty much flat in the initial overnight session. And then in the pre-market session, that's when we started to see some weakness come in, and it pretty much made for a flat open. And then we see where we went down and came back up. And then as the futures closed for the weekend, which is a holiday weekend, we were pretty much unchanged. But this is another warning sign and a negative divergence or a vulnerability that we're seeing. We still see where value is outperforming growth. The red line is above the blue line, and both of them are negative since we had the down day. But we're not seeing the blue line show a lot of strength right now. It's not necessarily falling apart, but it's not showing a lot of strength like what we saw throughout the month of November. That's when the market was really heading a lot higher. And since value is now outperforming, that is really keeping the indexes from really being able to go a lot higher as well. And we look at the 10-minute intraday chart of the growth to value ratio for the S&P, we ended up finishing down. Again, that's another slight warning sign. And throughout the latter part of December, we've been seeing growth really underperforming as the market has been going up. And that's another negative divergence that we're watching for. Here's the end of day chart where growth and value were down, but growth for the large caps was down more. It was down a little bit less for the mid caps and down a little bit less for the small caps, but everything ended up being down. This area in the middle, these are the core ETFs that we follow for the small, mid, and large caps, where they're broken down into growth and value on the left and on the right. And then here's our end of day chart, also showing that we're at the lower end of this range when we look at this ratio. We want to see this going up. And until this really goes up, that's another warning sign that we're paying attention to. Here's our trend where we're starting to drop below the moving average. Now, it's still really strong. The ADX is giving us a reading over 50 right now, and rarely does it ever get over 40. But the fact that it's coming down and starting to drop below the moving average could suggest that we're seeing a bit of a weakening trend. However, we still default to positive because the green line is above the red line, even though the green line is starting to show a bit of a decline. It's a little more pronounced in the short-term chart where we're dropping below the moving average and the green line is also coming down. We did see volume really start to go off. It picked up a little bit in Friday's session with the downward move, but overall it's still below average. And here's sentiment showing that we're not seeing a lot of fear yet when we look at the Ulcer Index. And when we look at the VIX, it was pretty much flat on the line chart as well as the bar chart. So we're not seeing a lot of fear coming through this way yet. When we look at the VIX of the VIX, or the volatility of the VIX, this is still showing that it picked up a little bit, but we're still below the moving averages for the bar chart and the line chart. This is what we've been keeping an eye on here. This is a correlation between the VIX and the S&P. It was giving us a high reading, not above this dashed line, but it still was kind of a high reading. And now it's starting to come down. And quite often when that has happened before, that's marked some kind of short to intermediate term top. We don't know if it's going to play out that way. This could still go up even higher. But if this does continue to fall, just be aware that even though it didn't get to this extreme reading, it may be giving us enough of an extreme reading that we need to pay attention to. Here's the equity put call ratio. We did decline just a little bit in Friday's session, even though we had the down day. But this is after the big spike up that we saw as folks were hedging ahead of the holiday. We saw it really drop in Thursday's session, and it dropped a little bit more in Friday's session. But when we look at the 5 period, we're continuing to go back up now, and that's more negative in the short to intermediate term. But when we look at our longer term charts, they're still going down, and that's longer term positive. We are showing a bit of a decline here with our risk on to risk off ratio. It declined in Friday's session, but overall it has been showing some improvement. In our advanced decline line studies, we had been just doing really well based on price and volume, but with the down day, we did turn down just a little bit. And even though the new highs are far outweighing any kind of new lows, we are seeing them really start to drop off. That's causing our 5 period to go sideways and our 10 period to actually start to go down. We were extreme positive with the advanced decline ratio, both with the 19 and 39 day exponential moving average. With the down day, these are no longer extreme positive. And we came down just a little bit to slightly flat with accumulation distribution. This tries to measure what the smart money is doing. When we're above this red line, which is a moving average, that means the smart money is buying. And we are a little bit concerned that we were getting kind of far away from this moving average. And the fact that it's coming down a little bit is not really a surprise, but it's still positive for now. Here's another smart money indicator, the chicken money flow, which after Thursday was giving us a really strong reading. It's starting to come down a little bit. It's still positive, but it could come down a little bit more as we're potentially working off this overbought condition. We did see a little bit of a turn down with our cumulative NYSE advanced decline line, but not really showing any real weakness, at least at this point. We also turned down slightly with our NYSE advanced decline line. And then our other NYSE advanced decline line also came down a little bit. But what's more encouraging is we're seeing a golden cross here. And these moving averages are based on the NYSE advanced decline line. So the fact that this is crossing over positive is also positive for the market. When we look at the common stock based on price, we did come down and we're coming back into this area where we were trying to break out, at least from this previous high. We're also turning down and coming back down to the same area, but not any real severe damage, at least to this point. When we look at our advanced decline line studies, we did turn down with the common stock on the NYSE, the S&P, the mid caps, and the small caps. But in the bigger picture, they still remain positive. They're above advancing moving averages. Looking at the daily chart where we came down, again, not really any damage to this point yet. We want to see, is this the start of something, or is this just a little bit of a pit stop before the market gets set to go up higher? On the bottom, you see where volume did pick up, but it's still well below average. We are still extreme with our 20 and 50 period moving average study and just barely extreme with the 200. The Williams percent R is declining, but is still extreme positive. This is another negative divergence or vulnerability that we're seeing. The force index, it's still positive, but it's coming down, and the midpoint is also starting to come down. It's picking up some more shorter term weakness that we're seeing. But when we look at our stochastics in the short term, we're still extreme, even though we're coming down, rolling over a bit in the intermediate short term, and we're still going up in the long short term. And the reason I say that is this chart is a further subdivision of the short term time frame. We're still extreme when we look at our standard deviations chart. We're up in the +3 channel still. We came down into the +2 area, but then with the recovery that we saw, we went back up into the +3 channel. We're just a little bit extreme positive with our 20 and 50 period moving average study. When we look at the boom indicator, this is how far away are we from the various moving averages. We still continue to be positive with the 200 moving average study. Intermediate term, we are coming down, but we're still extreme with the balance of power. The go-no-go system is still the darker blue here, and that's positive. And we're coming down just a little bit with the highest high value, but the midpoint continues to advance. And we're turning more of a darker shade of blue now with the TTM squeeze. That's a potential warning sign. And the ease of movement is starting to turn down, but it's still above 0. So it could be suggesting some weakness. And we came down a little bit with the Erin indicator as we saw selling pick up. That's the red line. And buyers came down slightly. That's the green line. And the oscillator measures the difference between the two. So since this had been giving us such an extreme positive reading, it's not really a surprise to see this coming down a bit. But when we look at the summation index based on price, we're continuing to go up. However, when you look at the summation index based on volume, we're starting to turn down after getting to an extreme reading. So that's something we want to be aware of. Sometimes this is a leading indicator for us. Now, we had a couple of false signals here recently where it was turning down and then ended up going back up. We don't know. Is that going to be a false signal this time, or is this going to lead to a more substantial decline? We continue to go up with the summation index for the NYSE based on price and volume, and we're actually breaking out above these previous highs based on volume. That is more of a positive convergence because we're seeing that volume is leading price. We're still hanging in there with our double and triple exponential moving average study based on 50 periods. As we were going up, this was acting as support, and we're kind of right at that point right now. We broke below it intraday, but we closed just about on the red line by the time we saw the bit of a bounce in Friday's session. We are starting to go back down with the Swenlin trading oscillator based on price and volume. We're still positive because we're above 0, but sometimes this can be a leading indicator for us. And we're still extreme when we look at the PMO all by itself. We're also extreme based on price as well as volume. We're not extreme, and this you could say is another negative divergence. We're going down with the PMOs that are rising as the S&P has been going up. We're also going down with the buy signals as the S&P has been going up, but we continue to be extreme positive with the PMOs that are above zero. We continue to be neutral for the Elder's Impulse system for the S&P. We continue to be positive with the parabolic SAR since the dots are underneath. And we're rolling over just a little bit with our slope oscillator. We're getting an extreme positive reading, and sometimes this is usually our touchiest oscillator. And if this turns and starts to go down, that could suggest more weakness might be coming. And the MACD is getting a little bit close to its moving average. It's still positive, and it's still giving us an extreme reading. But if this turns and starts to go down, that could also suggest some short to intermediate term weakness. So looking at all of our oscillators, we're rolling over a bit with the slope. The TSI is going sideways. We're rolling over just a little bit with the MACD. We're still positive with the PMO. We're right on top of the moving average with the PPO. These are our intermediate term oscillators. However, our long-term oscillators still continue to be positive, although the KST is starting to roll over a bit. We're still above all of the plotted moving averages. If we start to see some weakness, we're going to be looking at these moving averages to possibly provide support if we see some significant declines. The BPI is still hanging in there. It's giving us an extreme positive reading, but it hasn't started to roll over, at least yet. And with the NYSE bullish percent index, it's slowing down, but it's above 50 and advancing. So that's a broader market measure that is still positive. We are starting to roll over a bit with the NASDAQ 100 bullish percent index, and we're also coming off of a really extreme reading. We continue to go sideways, but we're still extreme with the Sean trend meter. It did decline a little bit on Friday. We're no longer extreme with the Chaikin oscillator, and this is continuing to go down. It's still above zero, so it's positive, but if we see this continue to drop off, it will eventually turn negative. We did turn down just a little bit with the money flow index, and we're not getting an extreme reading. We're above 50, though, so that's positive. And we're seeing pretty much that same thing with the ultimate oscillator. It did decline, but we're still above 50. We turned down just a little bit with the vortex, although the green line is still on top, so that is positive. And we're coming back up into an extreme positive reading with our rate of change based on 50 periods. We had been extreme. We worked that off. Then we became extreme again, worked that off. Now we're getting extreme again. As it's going back to the 50th period and calculating that, it's still giving us a pretty strong reading. The Copic curve is rolling over, but continues to be positive. And we're still extreme with the RSI 14, but we're no longer extreme with the RSI based on 9 periods. So these are starting to come back down after giving us extreme positive readings. We turned down just a little bit with the unbalanced volume, but we still continue to be positive. And we're getting very high readings with the 200-day moving average study. These are very high levels, suggesting that we are overbought. And so the fact that we're rolling over a bit is not a surprise. When we get up to the 90% level with the S&P based on 50 periods, that is also an extreme reading. And we've been up here for a while. To see this come down would not necessarily be a surprise. And the Pring bottom fisher, it's trying to generate a buy signal. This is usually after we've really been declining. And this is good at picking out those kind of signals. Well, we haven't been declining, and now it's giving us a buy signal. And sometimes we get some false signals from this chart. I don't have any Fibonacci line studies because we're still in no man's land, but we will be starting a new cycle on January 2nd based on the 50-day cycle that I've been using for about the last year or so. Sometimes this marks a top, sometimes a bottom, sometimes a continuation. We'll have to see. Maybe the days or the periods that are used in the cycle, something else will emerge in 2024 that can be helpful for us. Our different charts, we're still looking okay with the Heikin Ashi, even though we have a bit of a doji candle here. We turned down a little bit with the Kegi, but it's black, so it's still positive. We still continue to be positive with the Renko, and we're still looking okay with the 3-line break, even though these bars are pretty small. And then our long-term charts, we're still extreme with the 150 and 200-day moving average study. We're still above this long-term trend line when we look at a weekly chart of the S&P. And this trend line goes all the way back to the 1987 crash. If we see some more weakness, we'll be watching to see if this provides some kind of support. With the NASDAQ 100, we're right back down to the weekly chart going back to 2009. This may provide longer-term overhead resistance. Since we went above it, right now we're wondering if it's going to provide longer-term support. We're still looking okay with our equal weight index. It's been showing a lot of improvement as we've gone through the last couple months of 2023, and that's why we're seeing the ratio continuing to go down. When this was really going up, that means the mega caps were really outperforming. The fact that this is going down and the market has been going up suggests that we're seeing more broad market participation. But this is another warning sign. We were pretty much flat to slightly down with the Dow, but we did break out above this previous high. We never got back to this previous high with the transports, and they were down more than the Dow in Friday's session. So this is a longer-term negative divergence. We want to see the transports outperforming the Dow, and for the last couple of months, it's been underperforming the Dow. We saw kind of a little bit of a tick up with the utilities. And here, this is also showing where the red line, which are the transports, continues to underperform the Dow. In a good, solid environment, we want to see the red line going above the black line. But the Dow was down virtually unchanged, but it has had a pretty good year in 2023. But we continue to be neutral with the diamonds for the Elder's Impulse system. We did see a decline with the NASDAQ. It was down a little over 0.5%. Is this the beginning of something or just a little bit of a pullback before we get set to go higher? Also, the same thing with the NASDAQ 100. We closed well off the low, and that's positive, but this move down is a little scary looking. If we continue to see more weakness, we'll be looking for areas of support. We continue to be neutral with the QQQs when looking at the Elder's Impulse system. We're starting to look a little weaker here with the PPO. This is the momentum for the NASDAQ 100, and it's starting to cross below its moving average. But we're still looking okay on the weekly chart of the NASDAQ 100. Even though we didn't set a new all-time high on Friday, we did set multiple all-time highs throughout the last week. The small caps, we are seeing a recent golden cross here. They were down 1.32% in Friday's session. Okay, are they going to keep giving back some of their gains, or is this just a short-term pullback before we see the January effect kick back into gear and see the small caps going higher? We still remain neutral for the Elder's Impulse system for the small caps. When we look at our other small cap index, the Russell 2000, we're coming down with the RSI giving us an extreme reading, and then we're working off of that. We did see a decline with the price. If we continue to fall, this one area that had been resistance, will that now provide support? And we're also seeing a golden cross being generated. We're seeing a little bit of weakness with the momentum, but it still continues to be positive. The mid caps also generated a recent golden cross and gave back 0.91% of their gains on Friday. We continue to be neutral with the mid caps for the Elder's Impulse system. We saw a little bit of a decline with the financial sector, but it's still in a pretty solid uptrend. The micro caps also gave back 1.84% in Friday's session, and we're getting close here to seeing a potential golden cross. The blue moving average is getting close to crossing above the red moving average. The FANG index has pretty much been chopping sideways lately, and it was down 0.72%. The dollar was up. It had been down quite a bit over the last couple of weeks. The fact that it bounced back up slightly on Friday is not really surprising. We were up with the 10-year yield. We were down with the 10-year based on price. When we look at bonds, we're still getting even more of a positive answer when we take the 1 month and subtract the 3 month. This is really starting to shoot up. Other times this has happened, that meant there's some kind of crazy thing going on that's producing an unstable environment. When we saw this really skyrocketing around last spring, that was because of the debt ceiling crisis. What's making it go up this time? I still can't find any information about that. So we just watch this. We keep this in the back of our mind as a potential warning sign. And I have another chart to show you here. This is the 1 month and 3 month, where we're seeing the red line, which is the 3 month, now crossing below the 1 month yield. That doesn't happen very often, and that usually means something weird is happening that we may not know about yet. that the market is anticipating, but the news hasn't quite broken on it yet. Updating our possible positive scenarios, we're still looking okay with the cues to S&P. We're showing some weakness with discretionary, where we're dropping below the moving average when we compare that to the S&P. And this is disappointing, where we're seeing large cap growth underperforming large cap value. Looking at our other growth to value ratios, we are seeing some weakness with the large caps. We're still hanging in there with the mid caps, and we turned down just a little bit with the small caps. We're still getting a very high reading with our 10-day average of the S&P 500 highs minus the lows. We've been up here for a couple of weeks now, and that's just suggesting that so far the market's holding together. We're also looking positive when we look at the broad market. We take the highs minus the lows and then measure a 5-period moving average. We came down just a little bit, but we're still above zero and showing a lot of improvement. We're still going higher with our 50-period moving average study of the new highs minus the new lows for the S&P. That continues to go higher and is positive longer term. And we're getting almost an extreme positive reading with our 50-day moving average study for the S&P. We fell a little bit after being extreme with the mid caps, and we're falling a little bit as well with the small caps after getting an extreme positive reading. We're still tending to go up overall with our S&P to utilities ratio. When this is going up, the S&P is also going up. When this is going down, typically the S&P is also going down. And when we look at the 2-year yield, it continues to drop, and that's been giving good support to the S&P. Also, we ticked up a little bit with our staples to S&P 500 ratio, but overall it has been declining. When this declines, that gives good support to the S&P. So what's our outlook for Tuesday, January 2nd? The market will be closed on Monday for New Year's Day. That probably goes without saying, but I just feel I should throw it out there. We're wondering, is the Santa Claus rally still going to continue? There's still 2 days left. Is the January effect still going to continue once we get into the new year? There's really no earnings that we're dealing with right now. Our technicals are still positive, but we continue to be overbought when you take all of them together. We will get the S&P Global U.S. Manufacturing PMI, the final reading on Tuesday, and we're also going to get construction spending. And then we keep an eye on the geopolitical events. I'll be watching things over the holiday weekend to see if anything crazy happens, which may end up having an impact on Tuesday's session. Here's the economic calendar for the upcoming week. We are closed on Monday. I've already gone through what will be coming out on Tuesday. We're going to get ISM manufacturing. That's a pretty big one on Wednesday. We're going to get a lot more employment information on Thursday, and then we're getting the big employment situation report on Friday, as well as the ISM non-manufacturing PMI. So we're getting some pretty influential inflation type information that the market is going to digest. Seasonally, and I have some different things to look at now, and I forgot to do this. This should be changed from December to January. 2024 follows whatever happens in January. Now, we're not going to know that until the end of January, but if January's up or down, 72.6% of the time during a pre-election year, the market follows what happens in January. Okay, and then we're wondering if the January effect is still going to continue. That's why they call it the January effect. And then over the last 74 years in the month of January, we're up 59.5% of the time. We're down 40.5% of the time. I'll go through the options information as we get closer. When we look at seasonality, and this goes from 2002 up to 2022, the Dow, the S&P, and the NASDAQ are positive seasonally. People tend to kick off the new year with a positive outlook on things. We're wondering if the January effect is still going to continue. According to this chart, it lasts up until about the middle part of January. And then we're wondering, is 1982, is that going to be how we see things playing out as we enter into 2024? And then looking at the election year, where when the current president is running for re-election, we tend to start off pretty choppy in those types of years, where when it's not an election year, we tend to perform better. But then after we get beyond this, then we do see positive seasonality going forward. And then this is fun, the Stock Traders Almanac. We are only up until the middle part of 2023. So we're looking over in this area, and we're looking at the green dash line here, where it does tend to start out pretty flat before things end up turning more positive. Then when we look at the pre-election year, when the current president is running for re-election, that's the green line, and that tends to be positive. But we start off pretty good, then we see some weakness, then we bounce back a bit, then a little more weakness, and then choppiness as we tend to go higher for the rest of the year. Now, it doesn't mean it's going to play out that way. This is just what historically has happened. And I would really, really recommend, and I'll put a link for this in the description. I have a link to the 2023 version of the Stock Traders Almanac. I would really recommend that everybody who watches these videos, please get a copy of that book. I'm not an affiliate with Amazon or anything, so I don't get any kind of commission. I may change that in 2024, but there's really no financial benefit from me. The benefit is all for you. So the scenarios, we're not going with the down one yet, even though we did see some weakness on Friday, although we are seeing some potential areas of vulnerability and some negative divergences as we continue to be overbought. So we're still going with the up scenario, but be aware, we are seeing some vulnerabilities and we are overbought right now, but we would still lean towards the positive side because that's what our charts are telling us. And we're still looking extreme, even though we're seeing some weakness developing in our ADX indicators. The warning signs, growth is not participating. And to me, this is a pretty big one. And it's a negative longer-term divergence that we've been seeing for a couple of months now. The equity put call ratio based on 5 periods is going up. We're wondering, was that just hedging ahead of the holiday? Is it because we're overbought? Is it because sometimes at the latter part of December, we see some weakness? The transports are also negatively diverging from the Dow. That's also longer-term negative. And the 1 to 3 month short-term bond spread, it continues to be positive, and we're actually seeing the red and the blue line crossing each other on that other chart that I showed you. The positive signs, longer term, our daily special K chart is still positive. Also, the equity put call ratio based on 253 periods continues to go down. That's longer term positive. The risk on posture, even though it declined on Friday, is still showing improvement. Our oscillators are positive, but they're extreme positive. The parabolic SAR and the vortex chart, even though they're pulling back a bit, especially with the vortex, they continue to be positive. The bullish percent index really hasn't started to roll over yet. It's positive, but it's extreme positive. The Kopik curve is positive. The Zohorchak method is showing some improvement. And now we have the Russell, the small caps, and the mid caps generating longer-term uptrends when the 50-period moving average crosses above the 200-period moving average. Small and mid-cap growth, we're still seeing small cap growth lagging behind. It's near the bottom end of its recent channel, where mid-cap growth is more at the top end of the channel. They're still positive, but they're more or less chopping sideways. The financial sector, even though it declined on Friday, continues to be positive, and our longer-term new high, new low study based on 50 periods is still positive. So our conclusion, we're positive, but we continue to be overbought. It's going to take some time to work that off if that's what happens. In the short and intermediate term, we're also positive, but overbought, and we're still overbought in the long term, but we're positive on all the different time frames. So thank you. I want to wish you again a very happy New Year's. I hope 2024 is great for you. Over the weekend, I will be posting the weekly video, the intermarket analysis video, and the deep dive video. And then I'm planning on some new incremental videos that I'll be posting throughout 2024. So have a wonderful weekend, and I will talk to you in the next video.